Morning, Chris. How are you doing?
I'm good. How are you?
I am excellent there. This is Brian Jones. I'm here with Chris Hood, world's most interesting man, professional trader, Iron Man.
Every time you say that, I keep on thinking of what my wife would do if she was sitting in this room and she heard you say that. She would just basically try and reach through the screen and slap you, Brian, and say, "What's wrong with you, man?"
I mean, I think you're pretty interesting.
Oh, well, I'll buy you a drink.
Okay, perfect. I'll say it again. I'll just keep, you just keep buying me drinks. I like when you come down this way, we'll get some good bourbon.
One of my trading buddies, he's a bourbon fanatic, and when he was telling me about it, I tasted it for the first time last week. I was quite surprised. It was quite nice. It wasn't as sour or difficult to drink as Scotch whiskey, but I'm not an alcohol guy, so
yeah,
it was tasty.
It's got its own flavor. There's some really good ones and some that aren't so good.
Well, he was just going off, man. He was like, "Well, it's got to be in this case, in this case, in this case," and I was like, "Wow, that's fascinating."
Yeah, my palate's not that discriminating.
My palate's not refined at all when it comes to alcohol. So you could just give me moonshine and I would know what it is, man.
And we have that here too.
I suppose you've also got banjos, right?
Oh, we've got banjos and moonshine. We could set up a whole evening.
You could terrorize a couple people. That should be something in your school. If you're a douchebag on the mat, you've got to go and do the deliverance trail. We're going to go and set you up with a banjo and a bottle of moonshine and see how long you last.
No, it's chug moonshine, do burpees. Chug moonshine, do burpees.
Oh, just the thought of that makes me want to puke. Man. So what's been going on?
Not much. It was a rough week last week.
It was. I mean, I think this is normal. We've been talking about the September, October period since May, and we've been preparing for it. So we've been cutting our portfolio down. We've been looking at shorter duration trades. When you go back a couple of years and you look at the consistency of this period, you'll always see around September, October, things start to get really, really compressed in terms of performance. It's one of the few sort of blocks of time that you'll have during the year where making profits is just a little more difficult. It's not impossible. It's just a question of you get this lag of these positions that you would have created maybe back in July or August that sort of carry over into the period. Okay, so you take a little bit of heat. And I think this is the problem that a lot of retail traders have, is that the heat can be amplified when you look at the charts and you trade, candle by candle. So if you don't plan ahead and prepare, you could have come into September with a much larger portfolio with a wrongly skewed bias, right? So you were skewed to the upside. All these contracts or all these positions are sort of, they have to work in September. And market movements like we had last week can be pretty devastating. They can really, do damage. So as retail traders suffer that, right? So as their NLV, their net liquidation value of their account starts to decline because the spreads start to widen in these trades, the volatility starts to expand. They're all on, volatility negative positions. They need volatility to come down and volatility is going up. So everything's working against them. They start getting this emotional reaction to their portfolio. They see the red, and they go sell, 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 liquidate everything. And they go, that's it, I've had enough. And they wipe the sweat off their brow. Then the market turns around. And then they've got this memory, this DNA that's now changed, where it's like, don't believe the rally. And then it happens. And then by the time that rally is exhausted, a 2 ATR extension, they start saying, okay, maybe it's time to get back in, and they get absolutely hammered when it starts reverting to the mean. So this period is the one that I like to say to people, you trade really conservatively, super small positions, super strong setups, right? So always remember the mean. Where are we in relationship to the mean? Where are we in relationship to the daily 34, daily 21? You never go long underneath the daily 34. That, if you're a short-term trader, that's a dangerous thing, because that 34 acts like resistance. Then what you've got to be looking for is build your watch list. You've got to know the stocks you're going to be trading when the market reverts back to the upside. So, things I prefer to trade on the indexes. So things like SPXL, triple leveraged S&P 500, SSO, double leveraged S&P 500. Because when the market starts to turn, it's the indexes that are going to move first. It's going to be too difficult to pick the winners. It's difficult to pick those single stocks that are going to make a change. So, be careful. This is not a time for heroics. It's really a time for look at the setups, trade the setup. All right. Don't let your emotion, looking at your account value or whatever it is, distract you from what you're trying to do. Right. Remember, as a trader, your net liquidation value is a function of activities that happen outside of your control. You don't control the volatility in the market. You don't control the spread of liquidity in the market. So when those numbers get adjusted, when your account starts to fluctuate in value, you can't take it personally. The only choice you have is either to trade or not to trade. That's what you decide, right? And if you don't want to see your NLV going up and down, just don't trade. Make more cash, put more cash in your account and minimize the effect of volatility. But if you decide to trade, you accept the volatility as a consequence of that choice. For me personally, I try and manage my account in a way that I have one account with sub accounts, and my one sub account is my profit account. And every day that I trade, and I take my profit at the end of each day and I move it into my profit sub account. And in that sub account, I have long shares, I have positions that are hedges against the market. So that account will grow in value, but my trading sub account will always fluctuate in value because of the positions that it has. And that's how I manage it. Some people take their profit account and move it into a separate bank account. Some people, take the cash out and move it somewhere. I like to have it all in one book, but I can see the separate sub accounts within the structure of the account. So you just got to find a method that works for you. There's no right or wrong. It's just understand the consequence of choosing to trade is always volatility. And if the choice of your trading is I'm going to do 150 positions, they're always going to be bullish. Okay, well, when the market goes the other way, you have to remind yourself of the consequence of being 100% bullish and having 150 trades. That's what's going to happen. So it can sometimes be a little bit hard for beginners to learn that and accept it up front. It's a hard lesson.
Do you see downside risk for us right now? Do you see more downside?
Oh, yeah. I absolutely. I think when I'm going to share a screen and I'll show you, when you start looking at, you take SPY, for example, this is the S&P 500, just a simple analysis here using Fibonacci together with some ghost feeds. What you have here is we are trading so close to these lines, the 23.6 retracement level and the 0 line here. This is where everything starts to play out, right? This is the daily chart. When you trade near key Fibonacci extension and retracement levels, how price behaves at that point determines direction. So if we have a situation where we've got the market not closing above this line and falling to the downside, we may see more downside pressure, right? We might see, this is the options market forecasting to the 15th of, let me just put this on the hourly chart. If you look over here, if we use the hourly chart as our basis, right? That's what the options market is forecasting for the 15th of October. It's either going to be at 441 or it's going to be down at 415. That's the two choices. Market can go either way. Now, how we behave around these key inflection points, and I always call, major Fibonacci lines together with moving averages inflection points, how price behaves will determine direction. So if we land up having a situation where we have the price closing above the lines, okay, so if we have the price move back up above the 78.6 level here, and we start moving back in this direction, personally, this is just my opinion. This is not based on anything other than my own experiences. I would prefer that we went this way. Because if we go this way, we set up a better rally for us into the fourth quarter. If we go this way, we prolong and possibly intensify the downward potential. So we land up building more momentum to the downside by going up because the correction becomes bigger. So I would prefer this, and I would prefer it to happen sooner rather than later. I don't like Chinese water torture. I'm not a fan of that. So I prefer just sort of get it over and done with. I'd rather tolerate one swift kick in the nuts than, 55 flicks over an hour. I would rather just have one hard kick. I'll get over it. So here, this kind of pattern that we see forming down here at the 786 retracement and at the 100 retracement, this is what's going to determine direction. The next couple of days, depending on where we close, if we can close above the 8, that's this pink line over here. If we can close above the 8, and there's the 21, this is key. If we're still in between the 8 and the 21, and the 8's below the 21, the path of least resistance remains to the downside. So I'm quite bearish. I would say in the short term, I'm predicting, well, for myself, more downward momentum. I don't think we're going to get as far as there. I don't think that's going to happen. I think the bulls will have to step in at some point and start, buying the dip. That's going to happen. It's normal for that to happen. So if we start looking at where we are with price, we need to always validate it with our indicators at the bottom. So when we look over here, we've got no positive momentum. We've got our B score sits below 50. We've got no intraday moving average support. So we're pretty neutral to bearish in terms of structure of the moving averages on intraday timeframes. Our squeeze is not compressing. We don't have upward momentum here on the squeeze. And our stochastic is telling us that we're overbought. So we don't have anything telling us that this is going to go the other way. So any type of bounce that you have here may be short-lived, number one. Number two, if we get back to the 21, up to this green level, that green line over here, I think anything up to this level is shortable. So we have to understand that if we have long positions and we have a bounce back to the 21, which is the mean, the normal daily mean, from here, we could easily be falling back down here to 415.
Do you think
So,
rallies to the 21 would be shortable?
As long as price remains negatively stacked on the moving averages, right? So as long as we have negatively stacked moving averages, rallies to the 21 remain shortable. So I wouldn't short on the day that it touches the 21. I always wait for the confirmation candle the next day, and then you trade from there. Sometimes you will miss those opportunities. That happens. I've got my reversal indicators on as well. Those are indicating for me that we're still in a selling position. We don't have any momentum reversals at the moment. So until we get my orange diamond forming, there's nothing really for me to do long here. It's basically stay short. So we've got some bearish positions here on the SPY. Our short-term trading, our intraday trading is based on what we see in the first hour and a half of the day. So that could be a bullish day, it could be a bearish day. We don't know until we see what happens. But as far as I can tell from the market, everything depends on how price closes over the next couple of days. If we can get back above the 786 and we can start moving this way, I think that this is going to probably become more of a magnet, especially if we get some negative momentum. I think we could rally to the 21, sucker a whole lot of people in, and then bash the nonsense out of them. So that's how I see it. It's like, this is the sandbagging jiu-jitsu tournament. This is where you have all the brown belts are wearing white belts, and they're all signed up for a small division. And the white belts with 3 months of training have said that they're going to go in and tap everyone with a Kimura. So, what's going to happen is they're going to learn very quickly that anything up to the 21 is a shortable rally, and they're going to get their heads ripped off. And that's the fear that you have right now. So where the opportunities lie, rather than being completely negative, we definitely see natural gas. We got into a trade here around the 23rd of September on our entry signal that we had here, and we're up around 70% since we got into there. Boyle as well. So we got in here on the 24th. Energy looks really good. It's very extended. I mean, these are not entries I would take now. The entries were back here on the crossovers. Here we're already extended. I mean, we're now in profit taking territory up here at the 1618. Gold had a good day yesterday. Really nice sort of reversal pattern that's forming here. Although gold just hasn't really been a good trade for us this year at all. I certainly won't be trading it. It's on my do not trade list. XME starting to get a bit of life. It's coming down to the base of the 34 wave. It's above the 8, above the 21 and above the 8, but the 21 and the 8 are below the 34. So we're still not seeing a reversal of the pattern. Right? We need to see the alpha score above 70, and we need a little green dot here on the wave before we can get overly interested. Let's have a look. Uranium started to look quite interesting. Breakout pattern here off the descending channel. I like trading these patterns, but lots of selling pressure yesterday. So we had the alpha score go up, hit the 70, and then come back down. And our wave score was destined to go above 50, and then it dropped back. So I don't know if this is a strong candle yet. I don't know if this is going to be a sustained candle for me. Opening up at 24.40, I think that you've just got to see where this opens. If we have an inside day today, which is basically the price between the high of yesterday and the low of yesterday, if the candle doesn't break this high and get above the 23.6 extension here, I think that we're going to have a I think that we're going to go back down to the downside. So just watch that one carefully. Finance looks good. I like the setup that we have here. Wave score is green. We've got an alpha score above 70. We're going into slightly overbought. We're just passing the zero line, and we have a squeeze forming. So XLF looks interesting. I think that there may be a trade here. We're already in this trade. We got in over here on this entry signal on the reversal pattern. So we'll see where this one takes us. Let's see. Healthcare looks horrible. Absolutely horrible. Completely destroyed at the moment. Trend is now going double reds. So we've got the 8, the 21, 8, the 13, 21, and 34 all negatively stacked on high volume. Certainly don't want to be in here for now.
What's happened to biotech? It took a really big hit. I know.
Yeah, you know,
Moderna.
I think what happened, you know, these things are born with volatility, right? So biotech's sort of, you know, the nature of biotech is one of extreme. It's all about news events, right? So any form of news event is going to trigger something with these stocks. We've had our portfolios up about 100% for the year on our biotech stocks. Moderna was our best performer. It's now being replaced by Celldex. This is actually our top performing stock. We got in at around $12 a share back at the beginning of the year. It's now up at 56. So this has been a really, really good trade for us. These stocks are just naturally more volatile. And what you've got to do, if you're a biotech fan like I am, you've just got to make sure you don't let it become too big a weight within your capital because of the inherent volatility, right? So it's almost like you've got to weight biotech just a little bit less than what you would normally do to, say, maybe technology or one of the other sectors. So for me, it's a much smaller section of my reinvestment. It's a critical piece of my reinvestment, because if you can double that component every year, you would never put 100% of your money in it, because you could just as easily lose 100%. So you want to put maybe a 10, 12% allocation of your entire profit sort of portfolio into these stocks, and you're going to have volatility. That's just the price of entry, right? So Moderna, it got sold off when the announcement came that Merck had an oral vaccine or an oral tablet that could be used for COVID. But I think Moderna should be looked at more than just a COVID vaccine company. You know, its technology is a lot more transferable into other diseases as well. So I think Moderna will go back to $500. I mean, I think just now, you know, you're sitting in a situation where there's just a lot of bearish momentum behind it. So yesterday, you know, we got into the stock at around $72. So for us, this is still a very, very profitable trade. We've taken profits, we've reallocated, but for now we're out. And once we start seeing a resolve, you know, this downward trajectory resolve itself and start reversing, this is probably a great candidate for some bull put credit spreads for playing back to the mean. So, you know, it's just a matter of patience. This is a cycle. Moderna is prone to these sell-offs. Here we had a big one up from 497 and went down to $350. So $150. If you look over here, if we take the same extent, that's 457. This could probably bottom out at around 300, somewhere around this, the 2618. So I think we're probably at the floor. We just need to see some institutional support and volume come in. And then if we see, Moderna is going to open up today at 330, which is higher than yesterday. So we need to, again, start seeing these V-shaped candles. We could see ourselves rally back up to the 21. And then maybe it's a shorter bull trade from there. We'll have to see what transpires at that point. But looking at the under chart indicators, we have nothing bullish at the moment on Moderna. Looking at Google's one of my favorite stocks. I think Google, if the market's going to have a rally in the fourth quarter, I suspect Google and Amazon and Facebook will probably be the three that will lead the rally, because those three stocks have been hammered. And usually what happens is the stocks that get hammered the hardest in the downturn are the ones that recover the fastest in the reversal. So, Google is on my my watch list for a reversal trade. I do want to see it above the 8. Any type of trade on Google for me has to have a setup where it's above the 8. There was big volume yesterday on selling. Alpha score needs to start turning up. B score needs to go above 50. We need to have a squeeze. It needs a lot of repair. Like, this stuff can repair, it just has to do it first before I'll be interested. SMH was another one that got hit yesterday. If you look at the semis, this is a pretty big decline, from the sell order that we got the other day. It's declined from 269 down to 250. So that's a 6%, 7% move in 4 days. That's pretty big for this sector. And just selling. I think a lot of this has to do with the global supply issues that are there within the semiconductor space. This again will be one of the leading sectors to watch on your rebound. So one of the stocks to watch is actually SOXL. This is triple leveraged into the semiconductor space. When this turns around, this moves really, really fast. So your recovery stocks, Google, Amazon, Facebook, SPXL, SOXL, TQQQ, QLD, SSO, those are all stocks that have got a leveraged upside. So if you're not watching them, and this is where a lot of retail guys will sort of fall into the trap, is they sort of bleed in this period, and they go, that's it, I'm not doing this anymore. I can't do it. I can't do it. I'm going to take a break. I'm going to go sit in the Bahamas or something. And they go sit in the Bahamas, and their mindset is, I don't want to trade. I'm not good enough. And then these things reverse. And what they'll do is they'll gap. And when they start gapping, it's hard to catch. Now you've missed the opportunity to catch it on the rebound because you weren't watching. So mentally, you've just got to stay completely focused. And I think that this market will find a floor. At some point, it's going to find a floor. And if you're ready for it, it will be a very lucrative floor. And if you're not ready for it, it will be a very painful experience.
What do you think about, I've just heard a few people talk about still sort of this inflation narrative about inflationary assets. Do you have any thoughts on it or no? Trades?
I don't know. The thing is, I used to be very opinionated. My wife will disagree. She says I still am. But at the end of the day, I used to have this view, when you look at the media and you look at all the information that's available publicly, back in 2008, everyone was saying gold was going to 20,000. Every email that you got, everything was like gold, 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 gold. And then you sort of do it and gold never did it. And, I think the only way I can tell inflation actually exists is because of my own pocket. Like you go to the shops and you're paying a lot more for the things that cost you less last year. That's how you can really feel it happening. Is the price of food going to go up over the next 10 years? Absolutely. I mean, that's just a question of supply and demand. We just have too many people and not enough food. That's what happened. But when you start looking at the fudging of the numbers, this is the thing about disclosed inflation and real inflation. It's like the disclosed inflation is completely false because the basket of goods that the authorities use to calculate inflation is completely unrealistic. They don't look at things like used cars, and they don't look at things that we eat on a daily basis. I'm going to be, a bit silly here, but if your basket of goods contains caviar and filet mignon, it makes no difference to the guy who's buying bread and tins of tuna. It's rather look at the real stuff, right? They don't look at what the real basket of goods is. They construct the basket of goods to match the narratives that they want to talk about. They don't construct the basket of goods and keep it the same. I think over the last 20 years, I think there's a website called Shadow Stats. And what they do is they keep the basket of goods the same. So it's really interesting when you start reading, oh, if we just left the basket of goods exactly the same, let's see how much that pound of minced beef costs. Rather than, oh, minced beef's become too expensive, let's replace it with oxtail or something. I don't know what the feds do. I spend as little time as possible listening to elected officials with their opinions, because 90% of the time they only talk about their own self-interest. So I've got no interest in it. All I know is food will become more expensive. Gasoline and fuel are going to be cyclical like they've always been, based on seasons and consumption. So, if you go and have a look at the seasonality of oil prices and stuff, you can see what's going on there. The overarching inflation argument, I don't know. I'm not smart enough to argue it. There are some very, very smart analysts out there who have very compelling case for both stagflation, deflation, and inflation. And this is the funny part about financial information, is that you have all these smart people with all these degrees that will tell you what they think. But at the end of the day, you, without those degrees, has to make a choice as to who has the most compelling argument, and then go with that. This is the irony of the whole financial information industry, is that you've got two people talking about the same product, but they've got two opposing views, and you, without the knowledge, has to make a distinction as to who's right and who's wrong. At the end of the day, are you paying more for food now than you did a year ago? Yes, then inflation is happening. It can't be more complex than that. But I listened to a podcast where they had two economists. One was arguing for the inflation case. One was arguing for the deflation case. Both were right. Both of them, this is where economists can never be wrong, right? They basically say the same thing. They were both correct. There was no wrong answer. But at the end of the day, I still have to decide who do I think is holding more weight. And this is when it comes down to what style of clothes they wear. And I will always go with the guy who does jiu-jitsu. So if the economist is saying that there's a deflation argument, and he happens to be a jiu-jitsu student, I don't really care about anything else. I'll just believe him. He must be clever because he's doing jiu-jitsu. So,
that's true.
I'll go with that guy.
You made a comment the other day I thought was interesting about how the U.S. market tends to follow the German market. Is it? You want to speak to that at all?
Yeah, it's not that they follow. It's more a matter of when you.
I just want to know about that relationship.
Well, the Europeans tend to, remember, sentiment carries forward in session, right? So we've got Japan that has it first. If Japan's bullish, the Europeans take over from the Asians, and a little bit of their bullishness will go into the next session. And then if the Europeans are bearish, the Japanese bullish will sort of dilute, and then that bearishness will go into the next market. So it's like a cycle. It's just a cycle. So often what you can do is you can watch the Germans. So I watch, this is so funny. It's like, if you want to know what's going to happen, just follow the Germans. That's the, never mind anyone else. So it's a pretty simple thing. So when you start seeing the Germans, falling down, we tend to have a falling down day. The bearishness tends to continue. So when we had this reversal, that was our reversal, we could see in this pattern over here, I'm in the bottom left corner, this sort of candlestick pattern where we weren't making higher highs and higher lows. We sort of have these three candles all grouped together at the 34, at the base of the 34 wave. This is a pretty bearish pattern. So for this, you could actually tell, okay, well, I know that bad news is coming because we're not breaking through on the German side. The bullishness on the German side is not translating into an up market. Therefore, any bearishness that we have forming over here is going to translate into the session that we're going to have in the US. Now, to what degree, I have no idea. I mean, I'm just like, where are the correlations? Oh, isn't it funny that whenever we see bullishness happen over there, it tends to flood like a contagion. And then when we have bearishness, it floods like a contagion. Remember, all bad things, and I don't want to be mean on this, but all bad things come from the East. Okay. So, COVID, I'm kidding. I don't want to get political, but if you start thinking about it, the contagion that happened in 2008 started in China and Asia. The debt crisis started there and it went through. Look at what's happening now with Evergrande and all of this stuff in China. We're about 1 year away from a massive correction, and it's just a repeat of what we saw in 2008. So I think you've just got to realize that everything's connected. And when you start seeing correlation starting to happen, starting to see things happening or divergences starting to happen in markets where things are, prices moving in one direction, but all the oscillators underneath, the sentiment directive oscillators are giving you opposite readings to price, watch out. That's when things start to change. So with Germany, you've just got to, I watch it to give me a sort of introduction to how the day is going to pan out in the US. That's all. Is it always accurate? I'd say it's 60-40.
What's the last European session to close before the US?
It's the European session, so it will close in about 4 hours. So around about 10:30, around 11:30, it will close. 12:30 our time. So this sort of pattern that's forming here, you can see it's basing. We have a lower low than yesterday. We don't have a higher high, so it's a pretty negative sort of view. We don't have any momentum. We don't have any oversold statistics coming out here. So, we shouldn't expect too much. Any sort of relief rally we see at the morning open might not be long lived. It might just be a reversal and then, a quick bounce, and then we continue doing what we've been doing. That's how it works. So you can see interest rates starting to rise again. This is always bad for tech stocks. We've got volatility sitting above 22. So I have a range. So if volatility sits between 17.5 and 22, we're in what we call a cautious state. And I don't really want to be doing too much, to the upside if we are operating over there, because volatility is not your friend in this market. So you want to avoid that. If we look at the advanced declines, we're already showing pre-market negative 927. So we've got, a red day at the open. So we'll see where price puts us. If we look at the futures market, this is a 1 minute chart. You can see our extension indicator showing us price reversals. So I watch this pretty closely. This is what I use for day trading. When the sentiment and conditions are right for the trade strategy that I'm going to be doing for the day, I will do it. That's futures for S&P. This is NASDAQ. And you just sort of, you've just got to have a view at the moment of everything's connected, and you've got to remember that this won't last for long. As soon as you remember that it won't last for long, and you set yourself on where the goal is going to be, where the puck is going to go, that's what you want to be trading for. You want to be trading for the November reversal. That for me is the key, because we will make more money in November, from November to March, than you will through the rest of the entire year. So if you're not ready for the November reversal, you've oversized positions, you haven't managed your capital, whatever it is, you're going to be missing out. That's just the way it is. So, right now, there you can see we've got, selling signals coming, prices coming down. We had a positive reversal of momentum. You saw the green lines. Now we've got the red lines. So I just leave that on, and we adjust the timing during the day onto longer time frames, and that influences how we position our book for intraday trading. So this is sort of like the roadmap. This tells me where there's holes in the road and what to be careful for. And this is something that every trader should have on their screen in some way, shape, or form. you should be watching these 8 charts. These are the things that will tell you whether it's okay to trade or not. That's just the way it should work.
So one last question. So what are you looking at today for trading?
So today I have on my book, I'm looking at taking a bit of profit. So I've got a trade here on oil that's been moving up nicely. It's going to open up $4 up this morning. So this one should be quite profitable. We've also got a position we initiated yesterday on BTU. This one is also going to open up almost $1. This one should give us quite a nice profit at the open. It's already going to be opening up above the 100% retracement level. So we should be able to exit for a bit of profit. We've got a secondary profit target up here at 21. UNG, we're also looking to take profits on that one. We're looking to take profits on XLE. Let me see. As for new entries, there's very, very small, very light. I wouldn't say that I've got a lot of new positions that I would look for. I'm certainly looking to add to my SPY short, which is a long put position. If we can get to see SPY fail, I need to see it fail a couple of times before we can do that. So here we can see it's got to, I don't want it to get above this black line. If it gets above 434, then this line becomes probable. I want to keep it under 434 and I want to do this. I want to trade it down to this level here. I think that we're going to do that. I think that's what's going to happen. I don't think the bulls are just ready yet to come back in and play. I think the seasonality is going to win at the end of the day. And this is a season for to the downside for the next couple of weeks. But be careful. At the end of the day, just be careful. Don't oversize anything. Keep your positions light and take profits when you get it. So when you go into a trade, always know where you're going to exit. And don't let your P&L determine that. Don't say, oh, I'm going to make 100% and then I'll get out, because you'll get to 80%, not look at the charts, and that 80% gets wiped out the next day. You've just turned a winner into a loser. Rather look at the price of the underlying, set targets, either at your 2 ATR move, your 100% level, previous high, 1-to-1 extension, whatever it is, but stick with your rules. Don't deviate because of one candle. The big thing now is not to be overly influenced by one candle. So if we have an update today, you've got to look at it relative to the 8, the 21, the 13. Are we still negatively stacked? If so, path still to the downside. We could have an instant reversal. So just avoid, that sort of hype, that hype of, oh, everything's changed, let's go long. And then, you're at the soup kitchen on Friday because you bought some crazy meme stock thinking the world was going to go up. If in doubt, just trade the indexes and trade the indexes in one direction. Just go, one of the hardest things as a trader is to hold 2 conflicting ideas in your head at the same time. You can be bullish on an intraday basis and bearish on an overnight basis. So you've got to be able to hold 2 bullish and bearish idea at the same time. Just remember that your charts allow you the freedom to do that. So worth looking at, for guys that operate fast. You can trade a bearish position intraday and hold a bullish position for the next 3 months. That's completely possible. But good to see you, my friend.
You too. Great advice as always, and we will catch you next week.
Look forward to it. Have fun. Stay safe.
All right, you too. Take care.
Cheers, mate. Bye.